John, I love showing the log chart. It shows rate of change and shows emotion. What's our ability to get back to that trend line of disinflation seen back to the Volcker yields of long ago?
I think it's going to be incredibly difficult to get back to higher yields because the precondition for that is not just growth. The precondition is enough inflation to get the central banks to tighten. And that inflation may develop over the next 2 or 3 years, but I don't think it's part of the baseline for 2021. That's why I think rates can go up 30 or 40 basis points, but that's a pretty meaningless move compared to how much they've come down over the past several years.
The broader JPMorgan call, I think of Joyce Chang's summing it all together, and of course your work as well, is lower rates forever, and even some of your researchers speculating on very new, ever lower rates. When do you know to buy the paper hoping price up and yield lower?
I think if you're going to have yields lower in the U.S., because this is really the only bond market amongst the developed economies that can rally any more than 25 basis points, it's going to have to be on the back of some sort of macro shock or growth shock. So perhaps if Congress doesn't manage to pass stimulus in the lame duck session, if the data in the U.S. continue to soften, and that softening broadens out to other sectors, including, importantly, the labor market and consumption, this is what could give a rally in the bond market. But as I said, I think this is really limited to 25 basis points. If anyone is looking for bigger bond market rallies than that, it's going to have to come in the emerging markets where rates are higher and there's some scope to cut rates because of inflation being low. It's not going to come in the developed markets.
John, how are you expecting the recovery to take place? And good morning, first of all. How are you expecting the recovery to take place in the U.S. in 2021? How big can the recovery and how quickly can it come once a vaccine is approved in the U.S.?
Well, I think because the vaccine is likely to be rolled out concurrent with a number of other developments like more fiscal stimulus in the U.S. and a modest amount of additional Fed easing by increasing the maturity of their asset purchases. I think the combination of all of those is what gives a mini boom. A mini boom is maybe 4 or 5% growth in the U.S. The maxi boom is what we saw over the spring because of the lockdowns and the much more extraordinary monetary and fiscal stimulus. So it's a bit of a repeat of the broad kind of contours of what we witnessed in the spring and the summer. The magnitudes are going to be much smaller because the extent of lockdowns is more modest and the extent of stimulus is more modest. But I think it'd be pretty easy to get above trend growth after the first quarter stumble simply because of this convergence of reopening of the economy, some fiscal stimulus, and the vaccine rollout.